Good afternoon, everyone. I'd like to make a quick video today to show you how to recognize and react to volatility before you actually place a trade. The recent tariffs have created a tremendous amount of volatility in the markets over the past week or so. And so we'll just take a quick look at how to see the volatility in the market and how to react to it. Now, before I go any further, to take a free trial with us, go to tvtrades.com. That's tv-trades.com. Go to tvtrades.com and sign up for the trial. There's a free 3-day trial. With that, you get access to all the tools that we have. After the trial, it's only $25 a week or $90 a month or $9.97 a year. You can choose whichever you want. You can upgrade from one to the other, however you want to do it. All right, tv-trades.com to sign up for the free trial. Now, just quickly, when you open up your DOMs and they look like this, you see how we have a spread here. This is the gold. We have a spread there, just a tick spread in gold. We have a 2-tick spread here in the Russell. We have a couple tick spread here in the ES, and we have several ticks, like 10-tick spread right there in the NQ. When your DOMs look like that, when you open them up in the morning, you know that the market is going to be volatile. You know that there's an incredible amount of volatility in the markets because the markets are trading super thin. When I say thin, I mean there's very little on the bid and ask on either side. You can see here on the ES there's a spread between the bid and the ask, which there almost never is. But beyond that, there's a whole bunch of single digits right here. These are normally triple digits, right? Triple digits, not single digits. When you see something like that, you know the markets are going to be incredibly volatile. So you can't take trades that are really aggressive. Okay, you have to take things that actually commit to one direction or the other. And that brings us to this type of trade right here. All right, it's conservative TV trades, trend trade, short. This is for a short trade. It's the opposite for a long trade. But basically, what you look for, step one is make sure the background is the right color, red for a short or blue for a long. Step two, you want the trigger down here to come out of the oversold before it gives you an indication to go short. You want it to have a full cycle from the oversold up to the overbought. So it comes out of the oversold, then it comes the background is red. The background is red. Then it comes out of the oversold and it goes into the overbought. A full cycle from oversold up to overbought. And then the actual trigger is when it drops out of the overbought. Right here, number 4. When it comes out of the overbought, you would enter on the bar after the one that pulls it out of the overbought. Enter at the open of the bar after. Be right there with your entry point. Okay, if you're interested in this and you want to see more things like this, sign up for the free trial at tvtrades.com, tv-trades.com. Okay, in those really volatile markets on Monday, we were able to get $27,200 in profit with 10 contracts Monday morning. Most of that was on the Russell. Once I saw that the NQ was like this, I just didn't trade the NQ all morning. And the ES was gapping around, so I didn't trade the ES, and the gold was gapping, so I didn't trade the gold either. I primarily traded, I traded a little bit of gold, a little bit of ES, and I made money on both of those. But when they started to gap too much, I just stuck with the Russell. And we made over 500 ticks, I think, on the Russell, or pretty close to 500 ticks on the Russell Monday morning with one contract. So multiply that times 10 because we traded 10 contracts, as you can see up here. We trade 10 contracts all the time. Again, if you want to see things like this and the aggressive trend trades that we do when the markets are not trending, go to tvtrades.com. All right, sign up for the free trial at tvtrades.com. Thanks for watching.